Welcome to Session 4 of Market Risk Management. In this session, we focus on one of the most important aspects of risk control in banks and financial institutions, market risk measurement techniques. So far, we have understood what market risk is, how it impacts institutions, and how hedging helps manage that risk. Now, we move to the next critical step: how banks measure market risk numerically on a daily basis to control exposures, set limits, and protect capital. Let us begin. In this session, our objective is very clear: to understand how market risk is measured in practice inside banks and treasury desks. You will learn why market risk measurement is critical for daily risk control and regulatory compliance. We will go through the key measurement approaches used by banks, starting with sensitivity measures, then moving to value at risk, and finally stress testing. Most importantly, we will focus on the practical interpretation of these measures, how risk managers and traders use these numbers to make real decisions. By the end of the session, you will be able to understand how market risk is quantified, monitored, and controlled on a daily basis. Measuring market risk is not a theoretical exercise. It directly impacts how banks operate every day. The first purpose is to quantify potential loss. Without measurement, risk remains a guess. With measurement, it becomes a number that can be managed. These measurements help in setting trading limits for desks and dealers, ensuring exposures remain within acceptable boundaries. They also support capital allocation, where banks decide how much capital must be set aside to absorb potential losses. Finally, market risk measurement is a regulatory requirement under frameworks such as Basel norms and FRTB, where institutions must demonstrate how they measure and control their market risk exposures. In short, what cannot be measured cannot be controlled. When banks measure market risk, they do not rely on a single method. There are two primary approaches used together. The first is sensitivity-based measurement. This tells us how much the portfolio value changes for small movements in market variables like interest rates, exchange rates, or prices. The second is statistical measurement, mainly through value at risk, or VAR. This estimates the maximum expected loss over a given time period with a certain confidence level. Sensitivity measures provide immediate exposure insight, while VAR provides a probabilistic loss estimate. Both approaches complement each other and are always used together, not separately. Sensitivity measures form the foundation of market risk measurement. These measures tell us how much the mark-to-market value of a position changes for small movements in market variables. Let's understand PV01, also called BPV, from an interest rate desk perspective. PV01 tells us the change in portfolio value for a 1 basis point movement in interest rates. For example, if a bond portfolio has a PV01 of 2 lakh rupees, it means that for every 1 basis point rise in interest rates, the portfolio will lose to lakh rupees. If rates fall by 1 basis point, it gains to lakh rupees. This measure is widely used for bonds and interest rates